Remember, we had two methods that we could use to record the uncollectability of accounts receivable. The first one was the direct method, which we went over in the last lesson. In this lesson, we're going to take a look at the allowance method, which is quite a bit more complex, but it is the more accurate of the two. The allowance method allows us to record bad debt expense in the period when the sales occur. At the end of the last lesson, remember I mentioned that the direct write-off method is not in accordance with generally accepted accounting principles because it doesn't hit the matching principle if you have large accounts receivable. So here's the allowance method in a nutshell. We create this new account called allowance for doubtful accounts. This will be a contra account, works opposite the accounts receivable. We will debit bad debts expense and sort of hold all of the ones that we think won't be collectible in this allowance account. So we're going to make an estimate of what we're not going to collect by the end of our fiscal year, and we're going to put it in this allowance account. Here's an example. We had credit sales of $300,000, and at the end of the year, $20,000 were uncollected. Based on our experience, we estimated $1,500 would be uncollectible. In our current assets section, you'll see we have the accounts receivable at $20,000. We subtract the allowance for doubtful accounts, and our net accounts receivable is $18,500. The alternative way to report this is under accounts receivable. We can just say accounts receivable net of $1,500 allowance or doubtful accounts. So here we have determining that the account is not collectible. So once we have established the allowance for doubtful accounts, we've made our estimate, and now we're actually determining that an account will not be collected. Then we go ahead and debit the allowance for doubtful accounts, and we write off the amount to the accounts receivable that we have determined we won't collect. So now there's our estimate of what we won't collect. Here's what we didn't collect. So we have remaining $980 that we're estimating won't be collected. The write-off does not affect the realizable value of the net of the accounts receivable. We still had the $1,500 in there, right? And the $20,000, now we wrote off the amount that we deemed not collectible. The allowance was reduced. Our net receivable is still the same number because we just moved it from one account to the other. If we collect the accounts, then we'll do the same thing like we did with the direct method, except we'll put it back against the allowance for doubtful accounts. And then when we receive the payment, we debit cash and credit accounts receivable. So now we restore our estimate back up to the $1,500. Next, we're going to look at estimating. How do we go about estimating that amount that won't be collected? One of the ways that we can do that is by using a sales approach. So this is called the income statement approach, and it's the percentage of sales method. The other method that we have is the accounts receivable method, referred to as the balance sheet approach. And in that method, it's going to be, we have two options, a percentage of accounts receivable, or we'll look at an aging of the accounts receivable and determine in those age classifications what we might not collect. The percentage sales method says the bad debts expense is computed as follows. Our current period sales times our bad debt percentage equals the estimated bad debts expense. So how we'll come up with that bad debt expense percentage is probably a historical. We'll look back over years and averages and see what has happened in the past, and we'll make an estimate about what that might be in the future. Here's an example. We've estimated that 0.6% of our credit sales only, our cash sales aren't included, will be uncollectible. So we take our $400,000 times the 0.6%, and we're determining that $2,400 will not be collected of those sales. So we debit bad debt expense and we credit the allowance for doubtful accounts. The percentage of receivables method says we're going to look at our accounts receivable. We're going to multiply that by a bad debt percentage, same thing as we did before. We'll find that through historical means probably. And our bad debt expense then is computed as this. This works a little bit different. We're going to take the total estimated bad debt expense minus the previous balance in the allowance account, and that gives me my current bad debt expense. So in this one, we're adjusting the allowance account. That's why it's called the balance sheet approach. In this one, the percentage of sales method, we're adjusting the expense amount. Therefore, it's the income statement approach. Income statement approach adjusts the expense amount. The balance sheet approach adjusts the balance sheet amount. Remember, balance sheet accounts have a balance, so we've got to compare what we estimate it will be to what it is and make our adjustment. The rule of the three things for adjusting. What is the current amount? What should it be? How do we get there? Let's take an example. Musicland had $50,000 in accounts receivable and a $200 credit balance in the allowance for doubtful accounts. Now note, the allowance for doubtful accounts can have a credit or a debit balance because we may have underestimated or overestimated. We estimate that 5% of our receivables are uncollectible, so we think that that ending balance should be $2,500. Well, we take a look. Our unadjusted balance is currently a credit balance of $200. We need it to be a credit balance of $2,500, so we are going to credit the allowance for doubtful accounts for $2,300 and debit bad debt expense for the difference. The aging of receivables method, same concept, balance sheet approach. We're going to adjust the allowance account. Allowance account carries a balance, so we have to figure out what it should be, what it is, and make the adjustment. In this case, we're going to take a look at our aging of accounts receivable. This tells us the net amount due is $2,270. This first amount, or excuse me, that's our estimate of uncollectible. Total receivables here, $50,000. $37,000 are not yet due. $6,500 are 1 to 30 days past due. $3,700 are 31 to 60 days past due, etc., etc. So you'll notice the percent uncollectible goes up as the balance becomes more past due. So by the time we get to the over 90 days, we're estimating that as much as 40% of that will not be collected. So to get our estimated uncollectible, we simply multiply that by those percentages that we've arrived at through historical means, total those all up, and we estimate that we should have $2,270 in our allowance account. Our allowance account currently, remembered, had $200. We need it to have $2,270. So our adjustment is a debit to bad debt expense for $2,070, a credit to the allowance account for $2,070. Now, what if that balance had been determine what current balance equals $500 debit? Make an adjusting entry to go from step 1 to step 2. So if our account up here, instead of being a $200 credit, was a $500 debit, we still need the ending balance to be a credit of $2,270. So we're going to say $2,270 minus a negative $500. Our adjustment is $2,770. Excuse me, I had a little sneeze there. So in summary, our estimates are as follows. The income statement approach, emphasis is on matching the revenues to the expenses, and that's going to be a percent of sales. It will be sales times the rate equals the bad debt expense. Most of the time, this is credit sales only, but if cash sales are insignificant, it will be total sales. The balance sheet focus emphasizes the realizable value of the accounts receivable. So what are they really worth? Here we're going to take the percent of receivables, or the aging of receivables method, accounts receivable times the percentage rate for the allowance, and then we adjust the allowance to the balance that it needs to be. Here we just adjust the expense, right? The aging of receivables, we age all of our accounts receivable, we multiply by the percentage, and we again adjust the allowance account. So on this approach, the balance sheet approach, balance sheet, accounts have balances, so we need to change this balance to what it should be. We need to look at what is it, what should it be, how do we get there? Income statement account reports our operations. This is simply going to be the expense that we're estimating. Let's go on to our practice set. We're going to start with exercise 7.6. Actually, I just looked at the timing and we're going to leave this as a lecture video, and the practice problems will be done in a separate video. So you'll need two videos for this module. So I'll have you get the practice set open up and we'll move on to that. So get your practice set open up the video for the practice sets, and you will complete this module.